Hello and welcome to my channel. In this video, we would be covering the topic risk management. This video is part of playlist uploaded on International Trade Finance. There are many other chapters and contents uploaded in this playlist, so do check out. You can get the link on the I button in the description as well as at the end of this video. Do hit the like button if you like the video and do not forget to subscribe to channel for more banking, finance and management videos. Now let's start with this one. So we would be covering the different type of risk that is involved in international trade finance and how to manage that. Mostly, we will be looking at currency risk, country and political risk, contract and credit risk, transport risk. So let me give you a brief understanding. We are talking about international trade, where the trade transactions, the business is happening at global level, cross-border between different countries. So think of it like when you start a shop in the market. For example, let's take it you want to start a garment shop, and you know that there are various risks involved in even starting a small shop in a particular market. What if that the products that you are providing, there is not much demand of that product in the market? What if already there are lot many competitors and people are not coming to your particular shop? What if the investment that you made in renting out that shop, buying the materials, the equipments is not recovered because you have low sales volume? So it was not as per your expectations. So forget about the profit margin. You were not even able to recover the cost. So there are different type of risk involved, even if we are talking about a small shop which we need to start in a market. So think of it like when we are talking about international trade, we are dealing with business at global level, which involves various type of risks that need to be managed. And again, the value of money involved is large, and thus the financial burden which would be created would also be at a larger level. So it becomes very important to manage the risk. See, we can totally not avoid the risk that is involved in the business, but the same can be minimized with proper planning and management. So this makes us come to the 5-step rule to manage the risk: identify, assess, manage, monitor, review. It seems to sound simpler, but it's complicated when you actually implement it. You have to identify what all risks are involved. You have to assess, manage, monitor, and then keep on reviewing at the risk levels which are involved in your business. The same applies at international trade finance as well. Just think of it like taking the same example. Before stepping into the market and starting your shop, you could have understand the supply and demand in the market. You could have distributed the samples and get the reviews from the people. You could have understand the competitors' product which are doing well and those which are not doing well. You could understand the loopholes in the market which can be used for making the profitability or opportunity. So, by analyzing things, by assessing things, identifying the risk involved, you could have been able to manage the risk more properly. The same applies at a larger level as well. So let's start with talking about our first risk, which is very prominent when we are dealing with international trade, that is transport risk. Transport risk refers to uncertainties and potential hazards associated with movement of goods from one country to another. These risks can include goods damage or loss. So we will be reading about this. Why is transport risk involved? Why is transport risk so important in international trade finance? See, the shipments that are involved, there are two parties settled in different countries. You being a seller, you are settled in India, but the buyer, the importer, is settled in another country, maybe it's US or Japan, and you need to ship the goods via sea route or air route. However you are shipping, you need to make sure that the goods are properly packaged. And because the timeline involved in shipment of goods from point A to point B will be a larger period of time, the amount of goods that are being transported would be a huge amount. The goods that we referred in international trade as cargo, that needs to be packaged properly so that the damage is not as much, and it can be it can be delivered or dispatched on time without any delay, so that it won't result into any financial loss. All these things need to be taken into consideration again, because we are making the shipment from one country to another country. Now, when we talk about goods damage or loss, see, the goods being transported can get damaged due to several reasons. It can be accident, there can be natural disaster while the goods have been in transit itself, there can be any natural disaster, there can be any theft. Who will take the responsibility if the goods are damaged, if the goods are lost? Because you need to keep in mind, when we are talking about international trade, we are talking about bulk orders, which involves a lot of money, which involves a huge amount of money in there, and which creates a financial burden on the seller, on both the seller and the buyer, if it is not properly traded as per the agreement. So goods can be damaged for any reason: accident, natural disaster, theft. That needs to be kept in mind. There can be transport delays. Maybe there can be some issues in custom clearance. You can say there can be logistical problems. The route that you decided, the transportation provider was not as per the expectation. It was not safely, your goods were not safely transported from one place to another. So there can be issues in custom clearance, there can be issues in logistical problems, because the goods are being, again I would like to mention, the goods are being shipped from one part to another country, which involves a large amount of time, which involves a lot of efforts and a lot many process to go through. As I mentioned, the custom clearance process. So there is lot many process also involved. In between, if anything happens, if the goods are damaged, if delays are happening, then who would bear the financial loss which is there? Because agreement exists. There is seller, there is buyer, there is a contract, there is agreement, and if the things are not being done as per the agreement, if there is any delay, if there is any damage to the goods, one will have to bear the financial burden, regardless of the fact that it is international trade or it is a small business. So just think of it like, for any reason, if the transport which is being made by seller to the buyer get delayed, there will be a missed deadline, and which would result into customer dissatisfaction. So the importer who have given the order can charge you for this, can cut out on the payment that has to be made, which will again be a financial loss for the seller or the exporter. There can be unexpected expenses as well. For example, if you are insuring the goods, there can be higher insurance premiums that you are paying for it. Freight charges could be higher, storage fees, etc. So there can be unexpected expenses also involved, which need to be properly managed. Currency fluctuations. Currency fluctuation is also one of the prominent risks. And you see, because there is transaction happening between different countries which are having their own currency, and the fluctuation in the exchange rate during the transportation period can affect the value of transaction. So you decided at a certain price, but till the transaction actually happened, the currency fluctuation was there. The exchange rate might got higher, and there was difference in the exchange rate, which resulted into financial losses. So there is currency fluctuations which need to be taken into consideration. Then there is regulatory compliances. Different countries have their different regulations, rules and regulations regarding documentation, what is the standard of the product, the quality of product, the checking process, the tariffs that is included, the taxes to be levied, and non-compliance with any of these can lead to fines and penalties, even seizure of the goods. So these all are the risk involved when your goods are in transit, are in between the transportation from one point A to point B. These risks are always there, which needs to be managed. So this is said that when you are dealing with a particular country, anyways, when we talk about regulatory compliance, there is standard way, there is standard compliance that needs to be followed. But if you are dealing with a certain country which is having their own rules and regulations, that need to be kept in mind while making any agreement or any trade transactions that needs to be done on a prior basis. So we took that example of our shop which you wanted to start in a market. If you are assessing the market before you are tapping into it, it would be a well step ahead to minimize the risk. Same goes on our international trade finance also. If you are dealing with any country, you are making any transaction, it's well in advance that you know about the rules, regulations and compliances related to the transactions that you will be making. So to manage all these transportation risks, business need to take due care. Now these we can summarize it like what all steps that the businesses need to take into consideration. Taking proper insurance coverage with low premium, as much low premium as possible, because the premiums will be low, but you are taking an insurance coverage and there is risk of natural disasters, theft, all those things which can be covered, and thus insurance becomes very important when we are talking about international trade transactions. So take proper insurance coverage, but try it with low premium. Proper packaging of goods is very important because we are making the shipment from one country to another country. So make sure to hire the logistics or transportation provider which are excellent at their service, which do a proper packaging of the goods so that they are not damaged in between the transit period. Transport insurance provides financial protection against various risks associated with movement of goods during transit. So scope of coverage that is involved in transport insurance includes your cargo, that is the goods that are being shipped from point A to point B, goods in transit also while the goods are in shipment, and if anything is happened in between the transit period, that is also covered in the insurance. Freight service liability, associated stock if any, all these things can be well covered in the transport insurance and need to be chosen appropriately according to the demand of the agreement, according to the product or the service that is being provided. If we want, we can also take an example. Now, just suppose that there is a company based in India which is manufacturing home appliances, and they want to transport it via sea to US, United States, because they have received certain bulk order regarding it. Now, to protect against these risks associated with transportation of the goods from India to US, they have purchased marine cargo insurance. Now, marine cargo insurance being in place provides a insurance coverage, and also there can be low premiums if chosen wisely. So during the transit, if ship encounters storm which causes a container to get damaged and submerged in seawater because of this sudden storm that happened, and this creates a financial burden on the exporter. Now, because the exporter is already having this marine cargo insurance, they can file a claim and get their reimbursement as per the terms and conditions. So it becomes very important that you go through the insurance terms and conditions so that you can make a proper claim, you can understand when you can make a claim, and you can utilize that power when if any such risk happened and if you are going to face any financial burden because of it. Now we will be talking about two more insurance that are very prominent in this transport risk in international trade. So sellers or buyers contingent interest insurance. You can know this. You should know this concept because it's important, and it would give you an idea that an exporter selling on FOB. So Incoterms, there is one video that I have uploaded on Incoterms in this International Trade Finance playlist. You can go check out the video. You will get a detailed understanding about the Incoterms. But in brief, if I have to mention, Incoterms decides the responsibility between the buyer and the seller, between the importer and the exporter, that if the goods are being shipped from point A to point B, the seller is associated in country A, the buyer is associated in country B. Who will take the responsibility of the goods till what stage? So it can't happen that the seller is taking responsibility all through the destination, like from point A till it is received till point B. There is different Incoterms decided which will which will define the responsibility, of the buyer and the seller, who have to take the responsibility of ensuring the goods till what place, till what destination. So that is divided according to the Incoterm, and Incoterm is decided between Incoterm is decided between the seller and buyer in the agreement itself, so that the responsibilities can be defined and the buyer and the seller can be assured that who has to take the responsibility of the goods from which point till which point. Okay, I hope you are understanding this. Now, seller or buyer contingent interest insurance is a different concept. I told you about Incoterms, which defines the responsibility of whether the buyer or the seller will be taking the insurance responsibility from which point till when. While the goods are in transit, who will take the responsibility? That is defined in Incoterm, and that is decided by the buyer and seller. Now, when this Incoterm is divided, even after that, sellers, if they want, they can take extra coverage to protect, to be assured that I have taken extra coverage, extra insurance to protect my goods, and I am taking the responsibility. Even it is decided in the agreement, I am taking by my choice by paying a higher amount of premium to be double assured of my transaction. Now, this comes to the concept of sellers or buyers contingent interest insurance. Contingent interest means by their own interest, it's not required, but by their own interest, if the buyer want, they can take extra cover. If the seller want, they can take extra insurance cover for the goods to be safe. An exporter selling on FOB delivery terms with, according to contract, have no responsibility for insurance once the goods have reached the port. So there is this Incoterm called FOB, free on board, which means that the seller or the exporter will not have the responsibility of the goods after the goods have reached the port. Once the goods have reached the port, before that the responsibility was of the seller, but once it has reached the port, after that the responsibility would be moved on to the buyer. After that, there will be no responsibility on the seller side. So this is according to the Incoterm FOB decided between the seller and buyer. However, the seller is not satisfied and he wants to take extra cover. So this can be called as seller's interest insurance. The same way applies if the buyer is interested in taking interest insurance, in taking extra cover for the goods. Charter's liability insurance. Now, it is a type of insurance that provides coverage to charters who are entities or individuals that hire or lease ships from ship owner for transporting goods. The insurance protects charters against various risks associated with operations in chartering vessels. Now, who is a charter? So, charter can be any individual or any company or entity. Their work is to hire or lease ships from the ship owners. So there are people who are having enough money and they are having the ships of their own. So they provide to these entities on certain amount that they charge, and they provide the ships to these entities on lease or maybe on hire basis. So the charters are the individuals or entities who are hiring or leasing the ships from the ship owners, and then they are using it for transportation of the goods. So, charter can be held liable for damages to third-party insurance covered and thus needs to be protected. So, if anything happens to the ship, because the charter has hired or leased the ship from the ship owner, he is having certain liability. If anything happens to the ship, if any damage happens to the ship because of any natural disaster, because of any unforeseen circumstances, charter can be held responsible for that damage and can be asked for the financial loss to be covered to the ship owners. In that case, it becomes important that charter is having that charter's liability insurance in place, which will safeguard him from any financial burden created due to unforeseen events or circumstances. See, if the chartered vessel is involved in any incident which resulted into, we can say, oil spill, which resulted into environmental damage, and that can also be coming on charter itself and can be held responsible for the environmental damage that happened due to due to these incidents. Now, to safeguard charters against all these kind of risk that is involved, because he has hired or taken on lease the ship from the ship owners, he should have this charter's liability insurance, which would be safeguarding against these particular risk involved in providing the shipment facility to the exporters. Loss of profits or consequential loss insurance. Importers buying goods for a particular event may be interested in consequential loss cover in the case the goods are late. Suppose what happens that there is shipment being made. An exporter has got order due to a particular event that is happening in any country. A big event is going to take place in any country, and for that particular event, certain orders have been made to the exporter settled in another country. Now, the exporter has made shipment of the goods, but the shipment got delayed due to any circumstance, and till the shipment arrived at the destination in the another country where the event was supposed to take place, the event was already over because the shipment was delayed and the event already took place. So there is loss of profits or consequential loss insurance which can safeguard against any such incident. Because of the delay due to delayed shipment, one was unable to fulfill the orders from the customer on time, which led to loss of revenue and potential penalties that can come to the exporter. To safeguard against all these, there is this consequential loss insurance. So these are the different type of most prominent transport risk in insurance which you can see in international trade finance. We talked about marine cargo insurance, we talked about sellers or buyers contingent interest insurance, charters liability insurance, loss of profit or consequential loss insurance, and how the risk need to be managed when it comes to transport by taking proper insurance cover, by making proper packaging of the goods to avoid damage, by hiring a reliable logistic or transportation provider who have expertise in their service that they are providing. So all these things, all these matters need to be taken into consideration while you are dealing with international trade transactions. Now let's come to our currency risk. Why is currency risk so important? So what exactly is currency? Currency is the money that your particular country is using. Now different countries have their own currency. Like it is rupees for India, it can be dollar, it is dollar for United States, it is yen for Japan, it is euro for Europe. So there are different countries who are having their different currencies. It matters because suppose you visited US and you need to buy stuff over there, you will have to pay in dollar. Rupee won't be accepted over there for the payment that you are making. What you can do is get the rupee exchanged into dollars and then make the purchases. So in international trade also, while you are buying or selling goods with another country, you are getting payment in foreign currency. Now that foreign currency need to be converted into your currency so that you can utilize in your own country. You also know that currency comes with fluctuations. So currency is being traded and they fluctuate. Their exchange value is changing. So currency with exchange value is also subject to market fluctuations that needs to be taken into consideration, and it is one of the most significant thing that is impacting your cost and the profit margin. So if you haven't suppose you decided a particular value that according to that particular currency, the value because the currency rate at that particular moment of time when you decided on the agreement, it was a certain amount, but after the transaction really took place, the currency value increased and then the cost that you estimated was totally changed. So your estimation of the cost to get disturbed, your estimation of the revenue, the margin was also impacted. So currency fluctuations, currency exchange value which keeps on changing impacts a lot on international trade business. So here comes how to manage these risk that is involved in currency. There is one such way, currency hedging. Let's read about it. In international trade, businesses often deal with transactions in foreign currencies which exposes them to risk of adverse movements in exchange rates between the time of transaction is initiated and settled. Common hedging instruments are forward contracts. Okay. So we talked about the fluctuations that are happening in the currency, and you decided on certain cost, but then the cost was increased due to the increase in the currency rate, the currency exchange rate, and then you have to, your cost is increased and your margin, your profit margin is lower down because of that, and your business is all about maximizing your margin in best possible way. So it can't be like that. Currency hedging gives you an option where you can decide on the currency rate well in advance. So the first one is forward contracts. Now, when you are making a contract, there are two parties involved. We were talking about the exporter and the importer, and the agreement is being made between the two parties. They decided to exchange a certain amount of foreign currency at a predetermined exchange rate on a future date. So they decided that, okay, I'll be making you this shipment and the importer will be purchasing the goods, but the rate that was decided is fixed at a particular rate on a future date. So I'll be making you payment after the shipment is received by you on a certain particular date, and the exchange rate, the currency rate at that particular point of time will be this much. According, for example, will be like you can take the example, like let's take the example of US dollar. So maybe it's going right now it's going 69. I have decided on a predetermined rate. The US dollar rate might go down to 65 or 64. It might go up to 74 or 75, whatever it is, but we have pre-decided that our rate will be 68. So 68 is final, and on this currency rate at a future period of time when the goods get delivered, we will be exchanging the value. So the cost is already determined. The exchange rate is already determined on a future date. So forward contracts is providing with that option where the seller is certain, the buyer is certain that how much amount they have to pay and how much amount the one will receive. So these contracts are typically traded over the counter directly between the parties who are involved in the agreement or through intermediaries such as banks or brokers. Now there is a well-defined version of forward contracts which you can refer as future contracts. Future contracts functions exactly same like forward contracts where the currency rate is already decided, and in the future at a particular rate of currency the transaction will take place which is pre-decided between the buyer and the seller. But like in forward contract, the trading was happening over the counter between the two parties with the help of intermediaries like banks or brokers. Here the contract is made, and the same is the same like forward contracts, but these are traded on regulated stock exchanges. So like National Stock Exchange, BSE, Bombay Stock Exchange, which provides centralized trading platforms. So standardized contracts and clearing services are also provided to facilitate these transactions. The contract is same, the agreement is same, the rate and all, everything is decided, but there it was happening over the counter, and here the stock exchange is in the picture. So they are traded over the stock exchange. The transaction is being happened over the stock exchanges where it is regularized. Let's come to options contract. These contracts provides the parties with an option to buy or sell currency at a predetermined price on or before a specific future date. These are not obligatory like forwards or futures, but provides a choice to exercise power. Now, see, option contract is a more defined version, you can say, of both the forwards and the futures. In forward and future, it was obligatory. The rate was already decided, and no matter what, the currency rate comes down, the currency rate goes up in the market, the rate at which the seller and buyer decided, they have to do the transaction at that particular rate only. They have to make the transaction, they have to go as per the agreement decided between them. But here in option contracts, the parties are having an option that they might exercise the power or they might not exercise the power at a particular point of time. So here also they have predetermined the price for a specific future date. But for example, they pre-decided the price on a specific future date, but the person who has taken the option contract, maybe the seller has taken the option contract, he has made the shipment, and he was expecting the rate at maybe they have decided at a predetermined future rate of 68 as in US dollar, and this was what was decided between them. But they have taken but the seller has taken this option contract. And what happens that at a particular point of transaction where the payment need to be made in the market, the rate was much higher than 68. It might go to 70 or 71. The rate prevailing was higher than the 68. So what seller decided that he would not be exercising his power of the predetermined price of 68. He would be dealing at the market rate. Now these option contracts are providing the parties with an option to buy or sell currency at a predetermined price, but at their own will, their own choice. They are having the option to exercise power or not to exercise power depending on their profitability at that particular time. Yes, this can happen. And why would the option contract as being favorable to one party? How can it exist? Because one party is paying premiums for that. They are paying price to buy such contracts, to buy option contracts. They are paying specified price for this, that they want this power to exercise. Currency swaps. These are financial agreements between two parties to exchange cash flows in different currencies over a specific period. Currency swaps allow parties to hedge against currency risk by converting cash flows from one currency to another at a fixed exchange rate, reducing exposure to fluctuations in market. So let's take an example. Imagine you have this Japanese yen, but you need euro for a trip which you have to make to Europe. And your friend has euros, but he needs yen for a trip to Japan. Rather than going to bank and exchanging currency separately, you both decided on currency swap, that I will be giving you the foreign currency that you need and you give me the foreign currency that I need at a predetermined exchange rate, and always at the same rate we will be continuing this cash flow over a period of time. So take this on a larger level. This happens in international trade transactions also, where two parties or where two different parties, they comes into this agreement of currency swaps, and they keep on exchanging, they keep on converting the one currency to another currency at a predetermined exchange rate, where they don't have to get into the trouble of getting into fluctuations of the market and exchanging the currency at a regular basis by going through banks or intermediaries, etc. Now let's talk about different rates of currency exchanges that are often encountered due to various factors such as market dynamics and transaction timing. These common exchange rates are, first one is spot rate. Most of the exams that you will be giving on trade transactions, there will be certain questions about these rates, so you can keep this on mind. Spot rate is the current market rate at which one currency can be exchanged for another following an immediate settlement. Forward rate. It is the rate at which currency can be exchanged at a future date. So as we read about the forward contract that was made, it was on a future date at a predetermined price. So forward rate is the rate at which currency can be exchanged on a future date. Interbank exchange rate. These are the rate at which banks and financial institutions buy and sell currencies among themselves in the interbank market. Cross rate. The exchange rate between two currencies that are derived from a third currency, generally used for currencies that are not directly traded each against each other. So that is called cross rate. TT rate. It represents the exchange rate at which banks buy and sell foreign currencies for immediate delivery via telegraphic transfer. Now this reflects the current market exchange rate at the time of transaction, and mostly these telegraphic transfers are electronic transfer of funds between the banks or financial institution, which is typically used for sending money internationally or making large domestic payments. RBI reference rate. There is a benchmark exchange rate which is also published by RBI on daily basis, and it serves as a standard rate for currency conversion. RBI rate can be used as a basis for converting foreign currencies into Indian rupee, Businesses also use RBI rate for accounting and financial reporting purposes. Then there is bid and ask rate. If you need to simplify it, bid rate is buying price, ask rate is selling price. So bid rate is the highest price which a buyer is willing to pay for a particular foreign currency, and the sell rate is the price at which the seller is ready to sell a particular foreign currency in the market. So the bid rate is buying rate, the ask rate is the selling rate. Let's come to country and political risk. Political instability. It leads to frequent changes in trade policies, tariffs, compliance costs, regulations, creating uncertainty for businesses engaged in global trade transactions. Now, suppose you are dealing in trade transaction with an importer who is settled in a country that is rapidly changing its policies. Now, this will impact the regulatory environment, which can complicate the trade finance transactions. You see, political instability is also correlated to economic uncertainty that leads to currency volatility. And we read that if there is changes, if the currency is fluctuating a lot more, there is a lot more uncertainty because you are not able to define the cost and the your margin properly. So currency volatility because of this political instability is also correlated. If there is instability in political scenario in a particular country, it also increases the risk of non-payment or delayed payment by the trading partner. There can be conflict between two countries. Suppose you were not aware about that and you came into agreement with where the party is settled in a country, and suddenly your country and with that country there is conflict that is arising, there is geopolitical tension going on. This can disrupt the whole trade transactions because government can take actions, they can implement, they can change the policies, they can change the trading terms which will impact the parties involved in the agreement in the trade transaction, and which can again create a disruption in the business. Now, to minimize these kind of political instability, is better to do a thorough due diligence of the trading partner, where the trading partner is settled and how is the political scenario going between that country and your country. You need to do a proper due diligence. There should be political risk insurance in place. Trade finance instruments like the letter of credit and the bank guarantees are the more safer instruments, and that need to be used as a payment method. You can also diversify your geographic market so that in case you don't have to be dependent on one particular country because of any reason, if there is any war situation and you are not able to deal with that particular country, you are having other options in open for your product or services to be rendered in the market. Coming to legal and regulatory risk. Parties involved in trade must ensure proper documentation complying with regularity and legal standards, AML laws, sanctions, and approvals, to list a few. Non-compliance with all these results into legal liabilities, delayed transaction, increased costs, penalties, and reputational damage. So, you know that trade finance transactions, they involve a lot of documentation. There is extensive documentation and reporting to comply with the legal standards. Timely completion of all those custom declaration, the shipping documentation, the regulatory filing becomes important, and if that is avoided or if that is delayed, it can result into cost, penalties, and damage as such. To manage these legal and regulatory risks, it's better for business to implement a robust compliance program. You can also seek legal advice. It will always be sufficient that if you're not having an expertise in the legal and these kind of regulatory environment where you are dealing in the trade transaction, it's better to seek some legal advice, have collaboration with a legal counseling team, stay informed about the changes that are being implemented in the laws, and invest in some technical solution for the risk management. Sovereign default and credit risk. Sovereign default refers to a situation where a government is unable or unwilling to meet its debt obligation. It can affect traders who may have to face non-payment or delayed payment by government entities, resulting into financial losses. So do you know that there is this credit rating which is provided even to the countries and their ruling government? That is on the basis that how reliable a particular country and the ruling government is there. Are they in the position to do timely payments? Yeah, that all is divided, that all is defined by the credit rating that is being provided, which shows the credit worthiness. So that needs to be kept into a mind, because even if government entities are involved, there are chances of delayed payment, there are chances of financial losses. So you need to go through that. Currency controls and convertibility risk. Currency controls by government leads to limited access to foreign exchange in global market. It can also disrupt exchange rate volatility, distorting supply and demand mechanism of foreign currency. Now, currency controls are certainly implemented by the government to manage capital flows. There can be different reasons. When they want to manage capital flows, they want to stabilize the exchange rate, they want to control a market a bit in their own country's favor, they want to safeguard the monetary stability of the country. For all these reasons, government can implement certain currency control. Now, these currency control impact the business or the traders who are involved in global trading practices. Now, currency control may impose payment restrictions also, such as limit on amount of foreign currency that can be transferred abroad. So this would be in turn impacting the seller and the buyer that is involved. So these kind of risk is also there, which is related to the country, which is political, legal, sovereign and currency related risk, which is in the hand of government and the ruling government and the country in such. These risks need to be minimized through as I mentioned, seeking legal advice wherever necessary, being informed about the changes in the policies between the countries, being informed about the geopolitical situation of the countries, staying in touch with the latest solutions and technologies for risk management. Coming to our last slide, which is about contract and credit risk. So there are different type of contract. When we are talking about international trade finance, we read about different type of trade transaction methods. If you haven't gone through all the chapters, I would recommend you. I have already uploaded videos about these transaction methods like open account, advance payment, documentary collection, letter of credit. You must go through that so that you can have a better understanding. The chapters are uploaded in a sequence wise, so you can just go from chapter first to the latest one to have a broader understanding about the whole international trade transaction. There you will get an idea that how these transactions are having their own limitations and risk involved. If it is about open account trade transaction, advance payment, LCs involved, bank guarantees involved, they are having their own risk, which need to be taken into consideration by the importer and exporter if they are coming into any such agreement. Credit risk, also known as counterparty risk, arises from financial loss due to default of payment or insolvency of trading partner. Credit insurance covers the risk of non-payment of trade debts and enhanced risk mitigation. The insurer reimburses the insured for coverage portion after assessing the claim. Credit risk, in simple, you can understand this is like a default risk. What if the other party defaulted on the payment? So the party turned to be insolvent, is not ready to make the payment, but you are facing the financial burden because of that. So you can take insurance to cover the credit risk, and credit risk will always be there. To minimize it, you can use a better and effective trade transactions methods while making an agreement like letter of credit and bank guarantees, where there are banks and financial companies involved as an intermediary, which safeguards your payment. In bank guarantees, they also provide a guarantee to make the payment in case if any such default happens. So just take that into consideration. There are several ways to minimize the risk if you are getting into international trade transaction. That needs to be noted well before. Thank you for watching. I hope this video was valuable and useful for your learning. Thank you so much. Keep up the support.